Hello and welcome to The Print. This is Bidisha and you're watching Economics. Before we get into today's explainer, I would like to make an appeal. At The Print, we don't just report the news, we explain why it matters. Ground reporting takes time, travel, and resources. Sending reporters to the ground costs money. Building trust with communities takes days, sometimes even weeks. If you value this kind of reporting, then support us by becoming a subscriber. Subscribe to The Print today. For more than 3 decades, one number has shaped the global economy: China's growth rate. Year after year, China expanded at extraordinary speeds, often growing at 8, 9, even 10% annually. This rapid expansion transformed China from a largely agrarian society into the world's manufacturing powerhouse and the second largest economy. But something important is now changing. At China's annual parliamentary meetings this year, Beijing indicated that it is comfortable targeting economic growth of around 4.5 to 5%. For most countries, that would still be impressive. But for China, it represents a major shift. Because the economic model that powered China's spectacular rise for 4 decades is now beginning to run out of steam. To understand what is exactly happening today, we need to look at how China grew so rapidly in the first place. China's economic miracle rested on three powerful pillars: massive investment, export led manufacturing, and rapid urban construction. For decades, the country poured enormous resources into factories, highways, ports, railways, and even cities. High domestic savings, strong state coordination, and access to global markets allowed China to industrialize at an unprecedented speed. But at the center of this entire model was something even more important: the property sector. Housing construction, land sales, and real estate investment became one of the largest drivers of economic activity in China. This chart that you see on your screen shows just how central the property sector became to China's growth model. At its peak, real estate and related industries together accounted for roughly a quarter of China's GDP. And its influence extended far beyond housing. The property boom fueled demand for steel, for cement, glass, construction services, and also became a major source of revenue for local governments, which sold land to the developers. In many ways, property became the engine that powered the broader Chinese economy. But when an economy becomes this dependent on one sector, the risks can be significant. And those risks are now becoming visible. Over the past few years, China's property sector has entered into a prolonged downturn. Several major developers have struggled under massive debt burdens, housing demand has weakened, and property investment has slowed sharply. The consequences ripple through the entire economy. When property construction slows, steel demand falls, cement production declines, local government revenues shrink, and household wealth is affected. For many Chinese families, housing represents their largest financial asset. So, when the property market weakens, consumer confidence weakens as well. But the slowdown is not only about real estate. It reflects a deeper structural issue in China's development model. For decades, China relied heavily on investment driven growth. Building infrastructure and expanding industrial capacity generated enormous productivity gains, especially in the early stages of development. Millions of workers moved from agriculture into manufacturing. Cities expanded rapidly, and new infrastructure transformed the economy. Economists often refer to this phase as catch-up growth. Countries that industrialize later can grow quickly by adopting existing technologies, building basic infrastructure, and shifting labor into more productive sectors. However, this process eventually slows down. As an economy develops, additional investment begins to generate smaller gains. I would like to call this phenomenon as the diminishing returns to capital. In simple terms, the more highways, factories, and apartment buildings a country already has, the less additional growth each new investment produces. And China appears to be approaching that stage. The chart you see on your screen now illustrates the challenge. Despite continued high levels of investment, the economic returns generated by that investment have gradually declined over time. After decades of rapid development, China now has extensive infrastructure networks and vast manufacturing capacity. It has the largest high-speed rail system in the world. It also has enormous industrial capacity and highly developed urban centers. As a result, the easy gains from rapid catch-up growth are largely behind it. This pattern is not unique to China. Japan experienced a similar slowdown in the early 1970s after its post-war economic boom. South Korea and Taiwan also saw growth moderate after reaching middle-income levels. In development economics, this transition from rapid expansion to more stable growth is a common phase in successful economies. Chinese policymakers are well aware of these structural challenges. In recent years, Beijing has increasingly emphasized the idea of high-quality growth. This means shifting away from a model driven primarily by construction and heavy investment. One key goal is to increase the role of household consumption. Compared with many advanced economies, consumer spending accounts for a relatively small share of China's GDP. Therefore, encouraging households to spend more could make the economy less dependent on property and infrastructure investment. However, this transition is not as easy as you think. Weak housing markets, job uncertainty, and declining property wealth have made many households way more cautious about spending. At the same time, China is investing heavily in technology and innovation. Industries such as artificial intelligence, robotics, electric vehicles, and advanced manufacturing are expected to play a much larger role in the country's future growth. The goal is to move up the global value chain while reducing reliance on foreign technology. Even with slower growth, China will remain a central force in the global economy. But the nature of that influence is changing. A weaker property sector could reduce global demand for commodities that once fueled China's construction boom. At the same time, Chinese companies facing weaker domestic demand may expand more aggressively into international markets. That could intensify competition in manufacturing sectors worldwide. For countries like India, this moment is particularly significant. As China transitions to a phase of moderate growth, India is expected to experience faster economic expansion in the coming years. That divergence could reshape investment flows. It could also reshape supply chains and economic dynamics across Asia. But China's slowdown should not be misunderstood as an economic decline. What we are witnessing is transition. Many rapidly developing economies eventually move from high-speed catch-up growth to slower, more stable expansion. China is now entering that phase. The real story is not that China is faltering. It is that the era of miraculous double-digit growth that defined the global economy for a generation is gradually coming to an end. Thank you for watching.